Please help me welcome Dr. James L. Doty.
Thank you very much, Ian. Okay, forecast accuracy. Here's a comparison of actual, which is the black line, in real GDP, gross domestic product. And I'm going to really be focusing on gross domestic product this morning because that measure of economic, basically total spending, is probably the most comprehensive measure of the health and well-being of the overall economy. If we can nail real GDP, you'll have a pretty good idea how you're going to do and how the overall economy is going to be doing, even various sectors, because pretty much all of the individual areas, agriculture, industrial production, electronics, technology, moves with our GDP. So that's going to be my focus, and that's why I'm comparing our forecast that we issued in December of the prior year to the actual. As you can see, we caught the recession. We forecasted that. We forecasted the recovery, and since 2010, it's been a pretty boring forecast, quite frankly. We've said that the recovery will continue. It's not going to be gangbuster growth, but it will be positive growth. We will be generating some jobs, not a whole lot, but the economy will continue to grow as it has, around a 2% level. Now the question you should be asking, and probably are in your minds, okay, that looks pretty good, but you know, a forecast is only as good as how it compares to the competition. The other forecasting bureaus throughout the nation that are also forecasting real GDP, the most important measure of the economy. And in this study that looked at accuracy ranking for forecasts of real GDP, this is from 2004, 2014, that is every year over that 11-year period, actually. And we compared Chapman with all the other 30 blue chip forecasters around the nation. Here's the Chapman University #1. Not bad, huh? Yeah, so this isn't chopped liver up here when I'm presenting this forecast. We do have a track record, and it's kind of neat seeing UCLA #2. I'm glad it wasn't USC. They don't have a forecast because they put all their money into intercollegiate football and basketball. Anybody graduate from USC around here? Okay, that's it. No more USC. You have a great school. That's the end of it. Okay. Okay. Now let's look at what's going to happen to real GDP, and I'm going to try to touch the hot spots or the most important aspects or changes that you've been reading about and wondering how is that going to affect the overall economy. But this is what we've had in 2010, the 1.6. These are the changes that we've had. Most recently, 2.4%. We just had a revision in that, and this is the revised figure. So it's around 2.4%. We did very well. We were one of the closest forecasters to that growth rate. What I'm going to be trying to really focus on is what's happening in 2016. The current year. You read probably in this morning's paper or heard yesterday the Federal Reserve Board decided to not increase short-term rates by about 100 basis points, which they were kind of giving us a signal about in December, and now it looks like it's going to be more like 50 basis points. What's all that about? What's going on with all these oil industry, net exports, and all of this? So let's move on with that and start with the oil price shock and analyze what's actually gone on there. What's happening with oil? And well, we all know the crude oil price for a barrel has gone from $105. It was actually higher than that, but not too long ago. Basically in late 2014, it hit around 105, and then it plummeted. You had fracking, you had oversupplies, you had Iran oil coming back on the market, Iraq oil, so the Middle East was pumping out a lot of oil. In any event, the price plummeted to $31, and now it's recovered a little bit. I think it's around $38, close to $40 most recently. So it's moving around quite a bit, but obviously way down from what it was. The question is, how does that affect the economy? You know, real GDP is all about spending, and when When prices go down, the spending will be lower. But economists generally believe that, okay, if you spend less on gas, gasoline or energy-related products, you'll spend more in other areas, so it'll balance off. And this price drop brings prices down. So remember, we're talking about real GDP. That means spending adjusted for inflation. So if this brings down the inflation rate, that brings up real GDP. But here's the rub. Here's the problem that a lot of economists miss this, and that is we were all of a sudden spending so much on mining exploration and wells, $137 billion during a slow growth period. And the reason for this, 12, 13, 14, 15, with growth rates of around 2%, and we're spending $137 billion on wells when it was much lower than that in prior years, was because of fracking. All of a sudden, they developed a new technology, and as a result of this new technology, all of a sudden the U.S. was becoming a major producer of crude petroleum again. In fact, really number one again, almost a miracle, but it was because of this fracking. The problem is, once prices went down, spending on investment in exploration wells went all the way down to $70 billion. This hit in 2015, so you had a loss of roughly $70 billion in 1 year, just in this one area. And there's a multiplier effect. When you spend less on this, there's less in transportation, salaries are down, people lose jobs, and overall you have a multiplier effect, and the loss was probably closer to $150 billion. But that was 2015. We're in 2016. So the question is, by the end of 2015, we went down to $67 billion in spending, and that negatively affected the economy last year, no question. It would have been much higher than that 2.4% growth rate if we didn't have this drag bringing spending down. And even though prices of gasoline dropped, the consumer hadn't adjusted his or her spending to offset this. Now, as we go into 2016, we're already down to $67 billion. Quite frankly, it's probably not going to drop all that much more. There's always some base amount of spending, even on the fracking side, even on the exploration side, because there's a lot of capital still going into that area. But it'll probably decline, and could decline another $30 billion, another $30 billion or so. But all of a sudden, we're beginning to have the drop in the price of gasoline positively affecting other kinds of consumer spending. As you can see here, the average price of gasoline, this is national, not California, where it's much higher because of the cost of environmental spending in the refining side, but went from 230 to 170, a drop of 26%. I'm not going to make a long story short here. Basically, when you put all of that into our equations, that will increase spending on the consumer side by $80 billion. Remember, we're thinking maybe a $30 billion loss on the spending side, on the exploration side, on investment, but consumer up 80, 30 billion down on the investment side, net $50 billion. That's not even including the multiplier effect. So this year, unlike last year, the energy shock will have a positive impact on the economy rather than a negative. International trade. International trade has been a drag on the economy, on net exports for the last couple of years, and here's the reason why. Net exports, by the way, is what goes into GDP. When you measure GDP, if you remember, those of you who took principles of economics, hate to bring back horrible memories, but it was consumer spending, investment spending, government spending, plus net exports, which is exports minus imports. In the old days, it wasn't very important. Now it comprises a fairly significant portion of the total, roughly 10%. In any event, the dollar has appreciated against major currencies. This is an average. Obviously, it differs if you look at the euro, whatever, the yen, but this is a blend of our major trading partners, went up from 76 to 93. You're talking about a 20% increase over about a year and a half. This basically means that agricultural prices, if you were to sell to the trading partners, I think you probably mainly sell to China, but if you sell to trading partners, that means that the price of your product, even if it doesn't change, is about 20% higher because they have to convert their currency to dollars, and the dollar has appreciated in value. And this is even more the case with China, because the Chinese currency did depreciate against the dollar over this last year, and we could talk about that maybe in the Q&A. Anyway, in any event, you have this increase in the dollar. That increases the price of U.S. goods and services that we trade, our exports, increases the price, decreases the price of imports. Because the dollar is more valuable now, imports are cheaper. So you export less, import more, that brings down net exports. And that's why, in terms of percentage changes, you can see this drop in 14, 15, and what we're forecasting in 16 is negative. Obviously, this is having, because that big increase in the dollar had most of its impact in 2015. So this looks like net exports are continuing to drop, minus 10%. But this is very confusing. And if you learn anything today in my presentation, it's this. It's not the drop, it's the change that's important. And that is, this was a big drag on the economy, 17.6% negative, and now it's only going to be a 10% drag. In fact, in relative terms, net exports will be a positive in 2015 because we don't have to make up for that major drag on the economy that we had last year. So even though the dollar is still appreciating, and even though net exports are going to continue to decline, they're not going to decline as much. And as a result of that, it will have a positive impact on real GDP growth. I'm going to skip this. That's just in dollar terms. Let's go on to housing at the national level, U.S. housing. I'm going to go through the various indicators, variables that we look at in the Center for Economic Research at Chapman to determine what's happening to the housing industry. This includes apartments, single-family, condominiums, townhomes, the gamut. This is a survey taken of real estate professionals. They say, well, how do you think housing's doing, basically? And they come up with this index. I usually don't like indexes. Like, we don't even look to, we don't pay too much attention to the consumer confidence index, for example, because it doesn't seem to be a very reliable leading indicator. But here, look at how reliable this is. These gray areas, if you can see them, I'm not sure, but if you see these gray areas, these are recessions. Look at how this index dropped before the recession. You had a couple of years where, gee, it's dropping. That's a bad sign, because that kind of a drop indicates a recession. Same thing here. We did have a housing decline in the mid-90s. It didn't result in a recession. Here, you can see, this is the Great Recession. You can see the handwriting was on the wall if you looked at the real estate professionals, where their incomes are based on what's happening in the industry. They saw before anybody else the piling up inventories. So this here, as you can see most recently, what's happening, it's up. Real estate professionals feel good about the housing industry, which is a very, very good sign. The supply of unsold houses, which is it's calculated based on the number of months they take, how many houses are out there, how many months will it take to sell those homes that are unsold. And as you can see, the average is 6.3 months. It's down to 4.5, which means it's a tight supply. Another positive indicator on the housing side. The ratio of median home price to median family income is 3.3. Think about this. If you take in the numerator median home prices, let's just say $300,000, And median family income, just to keep it simple, is 100,000. That's your 300 divided by 100. That's your 3-to-1 ratio. The higher that is, let's say it goes to 400,000, median family income stays at 100, it's 4-to-1, which means it's less affordable. So the higher this is, the higher it goes above this historic ratio, the more unaffordable housing is, at least in this case in the US, because these are national data. So this is a negative in terms of housing becoming less affordable over the last couple of years. So you put these together, the housing market index is positive, the supply of unsold homes is positive because it's a tight supply that would increase production when supply is tight, and housing affordability, since it's less affordable, is negative. You put all of these things into our econometric model, and what comes out is more production, but not much. Almost 100,000 more units, from 1.1 million to about 1.2 million units that will be built in 2016. But the important thing to watch for is this change. Last year it was 10.5%, which was a healthy change, and that helped offset those problems in energy because of the drop in oil prices and the drop in investment spending and exploration. So this was good, and this was important in offsetting the negative side of the equation. Well, now you have 8.3, which is a little bit less juice you're adding to the real GDP equation. So it's slightly negative because it's not growing as much. Remember, it's growth, not the level. So the fact that it's going from 10.5 to 8.3 hardly matters, but it's slightly, if you want to think about it, slightly negative. Housing prices, we see nationally increasing about 4.4%, a little bit down from the almost 7% rate in 2015. That's national housing prices. I'm not going to spend too much time on that because prices are really a local phenomenon that vary significantly, and the U.S. is just an average of it all. It doesn't really mean very much. Okay, I don't usually talk about the government because the government, at least for the last 4 or 5 years, is not, since the big, remember during the later stages of the recession, there was both under Bush and under Obama, you had a big increase in fiscal spending. The fiscal stimulus was huge, like $1 trillion. It was huge, and then it backed off to the point where it didn't matter very much. So government spending had to tighten up because of the deficit, and as a result, government spending was not a very important factor. You could see it here in 11, 12, it was actually dropping. But recently, 15 and now in 16, it's entering positive terrain, both on the state and local and on the federal side. Not much, but remember, this was a drag on the economy. You don't have that drag anymore. You don't have to make up for it anymore by the good things, but now it's positive. At least positive in terms of more spending. And more spending, at least as far as real GDP is concerned, is a positive factor. So when you put all of these together, the oil price shock, because of the increase in consumer spending, because of the savings, not spending as much on gasoline, it nets out. Remember that 80-30 thing, the $50 billion net positive. Net exports, slightly positive, and housing, down not much, and government up because it's now above that 0 point, what I just spoke about. When you put it all together, our forecast calls for kind of another boring forecast, I'm sorry, about the same, maybe a little higher, 2.6%. You have some of the negative factors of less expiration, but more consumer spending. Trade is not going to be as bad as last year, so it's a little bit up. So anyway, 2.6%. So what I'm basically saying, overall, at least when you look at the U.S., the overall outlook is another year of recovery, to the point where this current recovery is becoming one of the longest recoveries since World War II. I think it's, well, you'll see in the top 3 or so. What does that mean for interest rates? The 90-day T-bill, which will move with the federal funds rate, which is under the control of the Federal Reserve Board, its announcement of going maybe 50 basis points instead of 100 means that it'll go up from around 0.1 to 0.6 by the end of the year, rather than about 1%, which it had announced in December. And the 10-year T-bond will move with it. Not initially, it will be dropping, and then by the end of the year will be slightly higher, about 2.4% on the long rate. Not much change. I mean, we're talking about 20 basis points. That's hardly any effect. You know, you're not really into anything until you're talking about 100, 200, 300 basis point change in long-term rates. Okay, let's look at this recovery. I think it's interesting to double check whether this Chapman forecast is on target or not, because there are a couple of other things you could look at to corroborate whether you're on the right track. That'll help you. Is this just an equations doing this, or are there other signs out there that tell us that we're basically on the right track and calling for another year of recovery? Here's the current recovery, now 78 months long. That's as of the end of last year, 78 months long. These are other long-lived recoveries. We've now gone beyond the 2001-7 recovery. We're now beyond this one here, which I'm not sure which one that was. But we have three that are still longer, quite a bit longer than the current 78 months, which suggests that we may have legs. This recovery still may have legs. It's beyond the average, but not only is it beyond the average, it's been a very weak recovery. This is accumulated real GDP growth. That is, you know, you add up the 2%, the 2%, the 2%, you add all those together, that's accumulated growth since the recovery began in 2010, the end of 2009. And this is the accumulated growth. But notice the accumulated growth on these longer lived recoveries was much greater. What that means is that with the weak recovery we've had, we're not bumping up against constraints that will limit potential continued growth. Like in these here, where they started getting to the point where inflation started picking up. Housing appreciation was going double digits, that kind of a thing, which spooks the Fed and causes the Fed to really tighten up. Well, as you can see here, the Fed's not that worried. In fact, they're probably as worried right now about deflation than they are inflation. And that's what led to the announcement yesterday that, hey, we're changing our tune. We're not too concerned about inflation as we were back in December. All kinds of problems. One problem is the dollar is appreciating, it's too high, and by tightening up, which we're planning to do with 100 basis, that would actually cause the dollar to appreciate even more, which would have a negative impact on employment in the U.S. and on trade, which is what we talked about. Anyway, so this suggests that while the recovery is beyond middle age, it probably has legs to continue. And our forecast, if you believe what we're saying now in 2016, would be that, and it will be up to 90 months by the end of 2016. Still shorter than the other three and much, much lower in terms of accumulated growth. Another variable that I think gives credence and support to our forecast of another year of recovery is that every time we've had a recession, every time, without exception, this goes all the way back to World War II, every recession was preceded by an inversion in interest rates. An inversion being short-term rates exceeding long-term rates. So if you take the difference between long and short and it becomes negative, that's a clear recession indicator. And the reason for that, by the way, is if short-term rates drop, if short-term rates increase at a lower rate than long-term rates, banks don't have as much of an incentive to loan money out, and that leads to a recession. By the way, that reminds me that Bank of America is your banker, and we have a long association at Chapman University. They're a sponsor of our forecast, so I want to thank you. It's kind of nice to be here because it's kind of also supporting A.P. Giannini, who was best friends of C.C. Chapman, the man for whom Chapman University is named. Just a little aside, something you learn on the side here. Anyway, here, the Great Recession, what happened was you had long-term rates dropping below short-term rates. Banks decided that they don't have much incentive to loan out if the borrowing costs more than the rates they're getting on their loans that they give out. So they stop lending, and it leads to these recessionary times. Okay, what are we seeing? Well, it's narrowing a bit because short-term rates are going to increase a little bit more than long-term rates, but not much, and it's not anywhere close to the 0 point. So that suggests, again, one more factor that suggests the recovery will continue. The ISM Manufacturing Purchasing Managers Index, you may be reading in the journal in your paper that this ISM is going down and it's below 50. And below 50 means that the manufacturing sector of the economy is declining. And it is, mainly because of this problem on the trade side. A lot of industrial is exports, and when the dollar increases in value and the prices of U.S. goods, agricultural goods as well, go up, there's less on the export side. So it is declining, but we've never had a recession unless that drops down way below 48, which is the most recent, down to like 35, 40. So and not only that, manufacturing is a much lower proportion of the overall economy, only around 12% now than it was before, and so it's been dropping. So there's nothing there. This is like the most negative thing that we're hearing about the current recovery, but in reality, it's not that significantly negative. And housing starts, another clear sign of recession. Notice you have drops of around 40, 50% before you have a recession. And while it's not growing all that much, around 10, it's clearly not in this terrain. So nothing on the housing side to suggest a recession. So overall, I think we are very confident that we will have another year of recovery. Whether it's going to be 2.2 or maybe 2.8, there's variation, surprises, things happen in the geopolitical framework to change things. But I think our forecast of around 2.5%, 2.6% is going to be pretty close to what actually happens by the end of the year. Okay, outlook for California. We'll focus on employment. We can't focus too much on gross state product like we do in the national side, gross domestic product, because we don't have good data on the state, and we don't get it quarterly. It's like annuals, and we get it very late. So we focused on employment, which moves pretty closely with gross state product. What are the explanatory variables? Well, real GDP. Real GDP is going to grow about as fast as it did last year, maybe a little more, but not much. So that's why it's not much of an impact. It's not going to have a big positive or negative. It's just going to contribute what it did last year. Net exports, as I pointed out before, a little higher, not much. In construction spending, let me go back to that. Construction spending, I will now explain, and that is around 3.7%. Notice that it's been dropping from 35% growth all the way down to 3.7%. Positive, but it's not as strong an engine of growth as it used to be, and that's really a negative. Even though it's positive, it's not the engine that's contributing a whole lot of growth in a disproportionately high side. Job growth in California, we see around 500,000. It's going to be 2.8, a little bit less than last year, but hardly significant. And if it's 3 or 3.2 or 2.6, we're in the ballpark. There's a range around our forecast, but basically we see about the same job growth in 2016 as we had in 2015. Very little change there. So it's not unlike real GDP. So while real GDP is a little bit higher nationally, California is a little bit weaker the way it's coming out. And part of that is agriculture, which I'll get to in a second. California's housing prices, this shows you historically what's happened, shows you the big increase pre-boom. This is the housing glut preceding the the Great Recession, then the big drop in prices, and then the recovery. But notice that California has still not fully recovered. On average, we are still underwater because those people who bought homes at the height, those homes have not recovered. A whole lot they have, but not fully recovered. They're still about $100,000 lower. What's in store for 2016? We see about 4.4% appreciation in the U.S., which I talked about before, 3.7, a little bit less in California. The reason it's a little bit less in California is that appreciation the last couple of years has been much greater in California, and incomes have not grown as much, so affordability of housing is more of a problem in California than it is in the U.S. Okay, some other factors that we need to pay attention to in California, not necessarily entering in on the employment side, but we need to keep an eye out. California's fiscal outlook is, well, good and bad. I'll start with the good. The ending reserve we're forecasting for 16-17 is $11 billion, which is a surplus. Very strong. Technology is growing. That's the main generator of this, and a lot of capital gains that the state is able to add to the coffers and the bottom line. The problem is the unfunded liability on pensions, which is significant. They're changing the unexpected rate of rate of return from 7.5 as CalPERS. They've been assuming that everything they have in the kitty, they're going to get 7.5% return, which is ridiculous. They're lowering it 6.5, which is still too high. Chapman's endowment, we're forecasting 4%, which we think is maybe a little too high, so we may be dropping it to 3.5. Well, every time you lower the expected rate of return, the unfunded liability increases, and as a result of this 100 basis point drop, unfunded liabilities will go up to $178 billion. You know, realistically, if we put in the real expected return, I think the unfunded liability is closer to $500 billion, $500 billion, which is an incredible problem. And nothing's being done about it, but it will come home to roost. And I think it will come more quickly because federal regulations are mandating CalPERS and other state agencies, local governments as well, to reduce its expected rate of return, which will show up in higher unfunded, which may press the case for the things that need to be done to correct that. Maybe we'll cover that in the Q&A. Another issue relating to California, longer term, is that while we're great in technology and innovation, especially with the Silicon Valley, access to capital is great. In terms of cost of doing business, business friendliness, cost of living, we're off the charts negatively, and that will limit our potential growth. And this explains why we've lost about 1.5 million net in population to these other states, especially Texas and Arizona. People leaving the state, real problem. The only reason our population is going up because of natural increase and immigration. Other than that, this flow is on the negative side. And the problem, the real sorry state, is that jobs, they're chasing jobs in these other states that are leaving California because of those variables we just talked about. So even though we're generating a significant surplus in the state, the problem with that is it's putting off these longer run problems of competitiveness of the state, over-regulation, and making it very difficult for businesses, particularly manufacturing businesses, to do business. We have this unfunded liability problem, which is going to come home to roost and negatively affect overall spending. Okay, impacts of the California drought. A lot of interesting statistics here. I got most of these data from UC Davis, but we did some extrapolation from it. This is in 2000. This is the most recent data on the drought. Net water shortage is 2.7 million feet, which isn't all that bad. The actual water cutoff was around 8 million acre square feet, which was considerable, but groundwater increases of around 6 million square feet, limited the drop back to 2.7 million. That's not insignificant, but it's not the disaster that everyone was expecting because there's much more groundwater reclamation taking place. Total economic losses that are estimated at $2.7 billion, a billion here, billion there, it all mounds up, but that's not all that significant. Figure, 2.7 billion, the California economy is around 2.1 trillion. So this is 0.1%. So when we talk about GDP growing 2.6% or the state growing around 2.5%, that's 0.1%, 0.1%, not a major impact. Similarly, total job losses of around 21,000 in the agricultural sector. Again, as a percentage of the 16 million people or 16 million jobs we have, that's 0.1%. So it has not had a significant impact. A lot of what agriculture is doing, most of the impact has been on the grains and cotton, seeds, that kind of industry. But on the vegetable, orchard crops, prices have gone up. That's offset some of the decline in production because those are inelastic rather than, I shouldn't use those terms. You can charge higher prices and consumers don't cut back that much. In fact, some products that are some of the orchard, like nuts, like some of the higher priced vegetables, they're so inelastic that even though quantity drops because of the drought, you're not able to produce as much, the price more than makes up for it and total revenue actually increases. Where it doesn't, where you have more commodity type products, cotton, grain products, feed products, feed, that's where the loss is. But in revenue terms, it's not having a significant impact as was expected. Now, what's the future? If we take the same drought conditions, actually they're much better, groundwater as well as reservoir water. But even if we assume a worst case scenario that the drought continues, it would continue with these kinds of losses all the way through 2017. Not, what I'm saying, it's not a horror story. It's negative, but it's not a major factor in the overall agricultural industry. And I think it's actually going to get better over the next couple of years. So I don't think it's something to worry a whole lot about. Much more worrisome is what's happening in China and what's going to happen to the yuan and the price appreciation of the dollar versus China's currency. Okay, I'm gonna end with something we do at Chapman. We have a forecasting equation, so you may want to know what's going to happen to the election. I'll conclude with that, and then have about 10 minutes for Q&A. Who will it be? Okay, what we've done at Chapman is, let's see, we have come up with an equation, all economic variables. So I'm not going to say anything about Trump and Hillary and all of that, because as an economist, I found out that people vote their pocketbooks, not personalities. If I put in an equation, which I did, I've developed an equation of CPI, Consumer Price Index, prices, real GDP, and employment, and that does a real good job in forecasting the popular vote count for the victorious party. In fact, if you go back all the way to 1972, and you put in this equation that you put in these variables for prices, unemployment, GDP, put all those in there, you get these forecasts. It forecasts every election. One mistake, 1992. It forecasted that the incumbent party, the Republican Party, would have won by 1.8%. It actually lost. That was Clinton's first election, 5.6%. It's the only, since 72. Just those three variables. That's all I'm putting in. It forecasts every one except that one, and I have a real good excuse. Anybody have an idea why the equation erred on that year?
No,
No, this was Oh yeah, you're right. That could have been it. You're right. This was Bush's second. When remember, and that's when he said, "Read my hips." Remember when they said, "Where's your vision?" Well, read my hips. When he was jogging outside. But yeah, no new taxes. Well, he raised taxes. But I don't think that's the reason. There's something else that happened during that election that this equation missed out on. Ross Perot got 20% of the vote, and most of those votes, not all of them, but most of them were drained off on the Republican side. And when you talk about 20%, that was one of the largest votes that a third-party candidate ever got. So the bottom line is the equation will mess up if there's a third-party candidate. Notice they had problems back with the Nixon-Humphrey when George Wallace ran as well. Anyway, this is very reliable. It doesn't look like we're going to have a third-party candidate, or at least a significant one in this election. So what is the equation telling us? Well, we plug in our forecast of CPI of 1.7%, real GDP 2.6. We talked about that. And employment, national employment 1.8%. What that comes out to is a victory by... I'm only the messenger here. Don't blame me. I'm just telling you, it's not personalities. She's really happy, isn't she? Anyway, I want to leave you with one little tip, which has helped me and may help you. So if you learn nothing about economics, here's a tip that I give you just as a little extra to the forecast here. I saw this photograph of Mrs. Clinton and saw this light around her head like a halo. It's like a saint of some sort, you know. I said, geez, you know, she has expensive PR people working, consultants. So there must be something about where she placed her head in that. These things are not just random. Because look at, I also saw this photograph of Ben Bernanke in the New York Times. Ben Bernanke's an economist like me. There's no one more boring than an economist. And that goes for Ben Bernanke. Yet you look at this photograph, the way the camera's looking out at him, the light shine. He looks like some kind of messiah. Well, he's got expensive PR people too. So I thought, hey, I don't have expensive PR people, but I can copy. You know, if they are doing something, there must be something to it. So I gave a forecast conference in Toronto, and the press after that was at a venerable old hotel like this, but it was a really old hotel, maybe Old Craftsman, and they were asking me. There was Q&A, and then they were taking photographs. I said, wait a minute, because they had me like some dingy background like this. And I said, wait a minute, I saw a light in the back. Come over here, take the... And here was the article. So, with all of these selfies that you taking, and our whole age is defined by photography now, with everybody taking it out, the photo. Don't have your photograph unless you can get some good light source in the back. Okay, for those of you who want to follow our research updates and so on, you could Google the Chapman University Anderson Center for Economic Research and get updates on our forecast. Invite you to do that. Also invite you to our forecast conferences held here in Orange County. In fact, the update forecast, sponsored by Bank of America, will be held in June. I don't remember the exact date, but just Google it and you'll find out. And it will be at the Musco Center for the Arts, which I just showed you earlier, which is an incredible new facility, not only in California, in Orange County, but really for all of us in California. And then in December, it's at the Segerstrom Performing Arts Center, also sponsored by B of A. So I hope you can attend those as well. And finally, we just inaugurated a new museum at Chapman, which is about 10 minutes away from here in the heart of Orange. It's the Hilbert Museum of California Art. It's California scene painting. It's basically art that was produced by people like Millard Sheets, Rex Brandt, and many other great artists between around 1920 to around 1970. and it's basically art of people working, living, playing, and agriculture is an important part of our state, so you'll see a lot of agricultural pictures. This is Imo Kosa, a great artist, back but from the right. But if you come, it's free admission, so I invite you all to visit our Hilbert Museum. I want to thank you for your attention. Next year, if you kindly invite us again, hopefully Essie Adibi will be here, but if he's not feeling well again, I'd be delighted to be here and speak. Thank you very much for your attention.